The crisis is one of the reasons why so-called sustainable investing is becoming more mainstream. Yesterday, I sat down with the president and CEO of Pax World Investments, Joe Keefe. I spoke with him about the origins of his company.
Pax World was started by two United Methodist ministers who launched the first socially responsible fund in the country back in 1971. They wanted to invest in a way that didn't support the Vietnam War, so they screened out weapons manufacturers. It's come a long way since then. We don't really look at it so much anymore as sort of negative screening, not investing in certain things. What we look at it as investing in companies that really have better environmental, social, and governance performance, ESG performance. That's what we call sustainable investing.
So what are the benefits of ESG analysis?
Well, it's really premised, Deirdre, upon the financial materiality of ESG. There's so much data now suggesting that companies with better environmental performance have, better efficiencies, lower costs, better performance over time. Companies are under increasing pressure to produce good environmental and social outcomes as well as financial outcomes, particularly in the wake of the recent financial crisis, where we've seen sort of the short-term focus and short-term incentives that are sort of built into our corporations and our markets today, sort of wreaking havoc with markets. It's a strategy for focusing on factors that we think will bear out over the long term. We believe it's a strategy for identifying better companies and building better investment portfolios.
But financially, it pays on the bottom line, and as you make reference to during the crisis, that's a lesson that a lot of people learn, that long-term thinking is more profitable than short-term thinking.
That's the whole premise. I mean, look at the BP case, where if you had focused on issues like worker safety and so forth, you might have understood that BP had some hidden liabilities. If you ignored those issues, you may have missed it. And there are all kinds of instances like that, particularly in the area of corporate governance, bad compensation incentive schemes that reward short-term extra risky behavior and so forth. Sustainable investing looks at those issues in a way that I think traditional financial analysis didn't.
Earlier, we brought you part of my conversation with Joe Keefe. He is the president and CEO of Pax World Investments, one of the best-known names in sustainable investing. Pax manages 12 funds, has one ETF and another one to come online soon. Pax also works in partnership with Morningstar. So yesterday, when I sat down with Joe, I asked him which investment ideas from this year added the most to his fund's performance.
Our chief investment officer and our portfolio managers really focused on industrials, on materials, on commodities, particularly on U.S. companies that were going to export to emerging market economies and so forth.
China, I'm guessing.
That worked well. China worked well. Brazil worked well. Those strategies worked very well, and we see those continuing into 2011. Information technology, U.S. industries that are going to continue to export and do business in emerging market economies, whose GDP growth is going to be substantial compared to developed countries.
Joe, I have to ask you this. I mean, when you look back to the year, what's your biggest investment regret?
I don't think we could have foreseen that, consumer discretionary would be, the best performing sector or one of the best performing sectors in the S&P 500. So we were probably a little underweight there. So
for the new year, what themes then, the ones that were successful from this calendar year, are you going to carry over? I mean, is it still worth the bet on industrials or on businesses that are linked to agricultural development?
I think so. And we're going to continue to pursue those themes. We think it's going to be a good year for equities. Bond yields. U.S. equities, for a couple of reasons. Bond yields have been at historic lows and they have nowhere to go but up. And also there's going to be sort of a flight to safety from Europe to U.S. domestic equities, I think, because of the problems that European countries are having. So we think it's going to be a good year for equities. We think it's going to be particularly a good year for sort of high quality companies, and that the income portion of total return will be a good place to be. So we see those themes playing out in 2011.
Looking to fixed income, you just made reference to treasuries. What if the bond vigilantes show up? I mean, what do you think about the U.S. deficit problem? I mean, it's a relative game as far as where investors' money goes.
Well, it is. And, obviously in this recent tax deal, President Obama and mostly Republicans chose stimulus over deficit reduction for the short term. But I think there's no doubt that over the longer term, we're going to have to start sending some signals this year that the U.S. is serious about its debt and is serious about deficit reduction, or else we're going to have longer term trouble.